Hi, welcome to Dig into China. I'm Dong Sheng. Recently, China's economy has been witnessing a series of peculiar phenomena that raise questions and suggest major shifts in its political and economic landscape. Many are still oblivious to these changes. The situation is influenced by both external and internal factors. As the global macroeconomic environment and domestic conditions evolve, the overall scenario becomes increasingly enigmatic. Why are China's economic phenomena become more bizarre? The underlying reason can be summed up with two characters, Kong and Za. These characters reflect the current state of China's economy and society. I'll explain their meaning soon, which will clarify the reasons behind China's strange social and economic trends that what might happen next. The first character, Kong, which means to short or bet against. Currently, many sectors are losing confidence in China's economy. The widespread belief is that the future economic situation will become even more difficult. And this pessimism continues to grow as evidenced by the movement of capital. Reports from Bloomberg and other outlets indicate that China's balance of payments released by the State Administration of Foreign Exchange shows a nearly $15 billion drop in foreign direct investment in the second quarter of this year, marking a significant exodus of foreign capital. This is only the second time in recorded history that the data has turned negative, and the scale of the outflow is the largest ever. The capital flow data shows that China is facing a net capital outflow, a trend that has been accelerating since 2019. After a brief rebound in 2023, the outflow is now gaining momentum again. Investors are expressing their true sentiments with their money, even if they publicly claim optimism about China's economy. Their actions, however, tell a different story as they move their capital out of the country. This reflects the current wave of large-scale capital exiting China. Judging by China's own economic data, it's not just the foreign investors. Many Chinese are eager to short their own economy if possible, and some data strongly highlight this reality. Starting with the real estate, Wind data shows that in August, the average daily transaction area of new homes across 61 sample cities dropped 16.9% year-on-year. Compared to the same period from 2019 to 2021, new home transactions have plummeted by 56.2% this August. On the pricing side, new home prices in 70 major cities hit record lows, with first, second, and third-tier cities all experiencing declines. The overall state of China's property market remains weak and stagnant. Regarding consumption, the year-on-year growth rate is still weak. The total retail sales of consumer goods increased by just 2.7%, reflecting continued sluggishness in overall economic activity. In the second quarter of this year, the growth rate of Chinese residents' income began to drop noticeably. In the first half of 2024, per capita disposable income increased by just 5.4% year-on-year, down 0.8 percentage point from the previous quarter. This slowdown explains the weak consumption, accelerating deflation, and a simultaneous decline in housing prices. With stagnant income levels, people have less money, which leads to falling prices. From the supply side, China's most recent industrial added value growth is 5.1% year-on-year, down from 5.3% previously. This suggests that demand is weaker than supply, which is a clear sign of superficial lack of money and demand. The growth rate of total social financing has reached a historical low for this period, showing that there is a lack of funds for both consumption and investment. This dire situation is also evident in China's broad monetary indicators. China's M2 growth rate is gradually declining, while the M1 growth rate has sharply dropped. This indicates that the market sentiment is low. There is a lack of investment demand, and the people are just saving their money. Those with capital are holding off and not exploring new opportunities. The overall data indicates a highly pessimistic and even perilous state of China's economy. This is one reason why foreign capital is withdrawing extensively. While foreign investors can exit, domestic investors are constrained by foreign exchange controls and cannot easily move their assets. Instead, they are buying relatively safe investments like Chinese government bonds. This is shown by the new record low yield on 10-year government bonds and the high bond prices. The recent surge in bond purchase highlighted by the media reflects the severe economic troubles and a complete loss of confidence in the economy. As we've seen from the statistics, China's real estate market is in trouble, consumption is weak, and investment prospects are bleak. Real estate investment lead to losses, stocks are underperforming, and funds and financial products are risky. With all these options failing, domestic investors find that escaping their financial woes is not feasible, leaving them with no choice but to turn to the bond market. Next, let's discuss the second keyword, 砸, coming from 砸锅卖铁. It is a Chinese idiom that literally means smashing pots and selling iron. It refers to a situation where someone is so desperate that they have to sell everything they own, including basic household items like pots and iron, to raise money. Recent news from mainland China indicates that the country has started forming a special task force for this purpose. However, this news was later refuted by authorities who removed the information and tried to downplay the issue. The term 砸锅卖铁, smashing pots and selling iron, has sparked debate online, with some netizens criticizing it as crude and indicative of a low cultural standard. The jokes are secondary. The key issue is understanding the purpose of the 砸锅卖铁 task force. What is the objective and what actions will it take? According to recent reports, the task force's primary mission is to find ways to activate local state-owned assets, manage funds and resources, and ultimately reduce local debt while increasing local revenue. The use of the crude term smashing pots and selling iron highlights the severity and imbalance in the officials' mindset. Local Chinese governments grappling with serious financial and economic troubles have, in a desperate move, established this so-called task force. Despite official attempts to deny it, some say the task force is still active and could be expanded in the future. The term 砸锅卖铁, smashing pots and selling iron, is deeply revealing. It contrasts starkly with the earlier concept of 空, short or bet against, shedding light on China's economic predicament. As the economy deteriorates, foreign capital flees while internal measures become increasingly desperate. However, after everything is sold off, the situation will only worsen. Foreign investors will have completely exited, and once everything is gone, even scrap metal may not sell, leading to widespread hardship for all. In essence, 砸锅卖铁, smashing pots and selling iron, and being pessimistic about China's economy are two aspects of the same issue. The very need to smashing pots stems from a belief that China's economic situation is dire. Hence, the Chinese Communist Party, by resorting to such extreme measures, demonstrates its own pessimism about China's economic recovery. The assumption is that without these drastic actions, the economy will not improve. 砸锅卖铁, smashing pots and selling iron, is not merely a policy but reflects an economic condition. When a country reaches this state, it indicates that serious problems are looming and significant issues are likely to arise. This phase represents the final stage of China's economic troubles. After this stage, China is expected to face major challenges and experience drastic political and economic changes. What changes are anticipated? How is 砸锅卖铁 actually being carried out? Here's a breakdown. On the surface, the term 砸锅卖铁 is driven by the high levels of debt among local governments, coupled with decrease in their revenues. According to Cai Xin, local government debt in China was over 40 trillion yuan at the end of last year, with annual interest payments exceeding 1.2 trillion yuan. By July 2024, the debt had increased to 42.8 trillion yuan, not including unaccounted for hidden debts. China's true debt levels are likely much higher than anticipated. Local governments have historically depended on land sales for revenue, but this source is rapidly diminishing. With the real estate market now in a severe downturn, government revenue is consequently facing significant challenges. From January to July 2024, local government land sales revenue amounted to 1.8 trillion yuan, marking a 22% decrease compared to the previous year. Compared to the high of 2021, land revenue has fallen by 33% in 2023. This indicates that while local debt is increasing, local revenue is declining. At the same time, foreign investment is exiting and private companies are falling. This means that the revenue from various business taxes and fees is also declining. Furthermore, as I mentioned before, the slowdown in resident income growth has made it increasingly difficult to collect taxes and fees from individuals. This scenario of shrinking revenue and rising debt has driven the Chinese government into a 砸锅卖铁, smashing pots and selling iron mode. It essentially means that the government is prepared to take extreme measures to boost its revenue sources. I often point out that as a Chinese dynasty nears the end of its rule, it usually encounters a problem of reduced government revenue and increased spending. Historically, dynasties have dealt with fiscal issues by resorting to harsh and blunt methods, such as imposing heavy taxes and inventing new fees. Ultimately, these measures end up exploiting the lower classes to cover the shortfall. The current regime faces a fiscal crisis akin to those faced by past dynasties on the brink of collapse. As a result, it is resorting to 砸锅卖铁 to manage the situation. However, here is a problem with selling off everything, deciding whose assets to target. As the ruling party and a vested interest, the Communist Party cannot dismantle its own resources. Instead, it targets assets held by others, such as private enterprises and the financial system. The goal is to seize these assets, transfer them to state ownership, and use them to boost government revenue and address the debt gap. Currently, the selling of everything approach is actively being implemented. The financial system has been a focus for some time, but given its size and complexity, it cannot be fully dismantled immediately. In 2023, the Chinese government publicly launched its campaign against the so-called financial elite, using media channels to announce its intention to tackle corruption in the financial sector and address issues like hedonism, luxury, and practices contrary to socialist values. After this announcement, the financial industry saw widespread salary cuts, layoffs, and a surge in resignations. Financial professionals at all levels have been hit hard, experiencing the significant impact of this selling off everything strategy. This year, there has been a significant wave of executive departures from major financial institutions in China. For instance, the president of the Bank of China recently resigned. Executives are leaving their positions in droves, with recent resignation including the president of Zhejiang Merchants Bank, the chairman of Harvest Fund, and the vice president of China Merchants Securities Corporation. Additionally, senior executives from the Guoyuan Securities have been taken away for investigation by authorities. This wave of departure and arrest shows no sign of abating, signaling that the selling of everything process in the financial sector has only just begun. The lower-income population in China may feel satisfied seeing the financial sector being dismantled, especially given the country's strong anti-wealth sentiment. However, they should be cautious and not celebrate too soon. Once Xi Jinping has dealt with the internet, the real estate, and the financial sectors, the focus will likely turn to the lower-income groups. At that point, they could find themselves facing even harsher measures. I can't predict or am particularly interested in the specific methods they will use, but given the Communist Party's experience and ingenuity in handling domestic issues, they are likely to come up with some unexpected strategies. We'll have to observe how they proceed. Regardless, their goal is clear: to dismantle the market economy and enforce a planned economy. After thoroughly destroying the market economy, only the path of socialist planned economy will remain. Considering the above analysis, it's easy to understand the fear and urgency driving foreign investors to leave China. In an era of selling off everything, staying put means facing the inevitable destruction and ending up as mere scrap metal. From this standpoint, I can assert with confidence that the capital that has left will probably not return. This follows the principles of international capital flow, which are driven by profit potential rather than merely cost differences. If capital moved only based on cost, the poorest and the lowest wage areas would receive the most foreign investment. In the 1990s, economist Robert Lucas analyzed why capital doesn't flow from wealthy to poorer countries in his paper, Why Doesn't Capital Flow from Rich to Poor Countries? He found that developed nations' capital does not move in large volumes to the lowest cost, highest marginal utility poor countries. This discrepancy arises because the principles of marginal utility don't fully apply to capital flows. The key reason includes difference in labor quality between countries, the spillover effects of human capital that enhance productivity and profits, and political risk of flawed market mechanism in poorer countries. These factors prevent capital from flowing from rich to poor nations. These three factors nearly explain why capital once it exits China doesn't return. First, Xi Jinping's political setbacks are causing a decline in educational standards and overall population quality, leading to a drop in labor quality. This decline might negate any benefits from lower labor costs due to China's worsening economic conditions. Consequently, even if Xi Jinping tries to revive the demographic dividend, foreign capital will likely see little advantage in returning. Second, the spillover effects of human capital in developed countries boost productivity and profits. The rapid advancement of technology such as artificial intelligence further enhances this effect, reducing the motivation for international capital to flow into poorer countries like China. Third, China's smashing the pot and selling iron policy, which increasingly rejects market economic rules, introduces significant political risks. This discourages international capital from investing in China. As a result of these combined factors, international capital is unlikely to return. Consequently, after the smashing the pot and selling iron policy, the scrap metal is left unsellable because the international investors have lost interest in it. There is no market for it. Therefore, I conclude that the smashing the pot and selling iron economic strategy is bound to fail, much like many of China's abandoned construction projects. This approach will eventually become another failed project. China's pattern of unfinished projects will persist, culminating in a significant collapse. Thank you so much for watching. If you find this video helpful, please like it, drop a comment below, and hit the subscribe button right here. It really helps YouTube suggest my video to others. I'll be back with more content soon. Until then, be well.